Okay, so I wanted to do, oh, sorry, this is Daniel, General Concepts. So what I wanted to do in this video was go a little bit more into debt elimination, and this may not be the perfect visualization, but to give you an idea of what you can do. So with this, I'm laying out just a very simple debt that someone may have. They may have three credit cards, one being 1,000, 3,000, 5,000, and these payments down here underneath it are the monthly payments. They may not be exact. They're not going to be perfect based on any interest rate. Um, but in many cases, say that the $1,000 a month could be a 28% interest rate. The 3,000 might be 22-ish, and the 5,000 might be 18. That's not unrealistic. Even with decent credit, you can still have those kind of high credit card, uh, interest rates. The car, I just approximated it might be $500 a month, uh, but that's more or less, I'm guessing, for about a $30,000 car or $30,000 in debt on a car. And if you were to purchase it new, more than likely, or not even new, you just whenever you made the purchase, it's $600. So the house at $250,000 I put in here is a 5% interest rate on over 30 years. That's what that payment is. Whether that anybody feels like that's high or low or whatever the case may be, this is just for demonstration purposes. As of the date of this recording, this could be actually low, really, because it's only going up. They're predicting that it'll be like 7% at the end of the year. It might be higher. And we don't know. We don't know what the Fed's going to do between now and then. But nonetheless, so debt elimination, with this, we're talking about how you would do this with the cash value life insurance policy and how this would work. And that's the point of this video. So I've talked too much. So please watch through to the end. It'll get you an idea of how this works and why you could utilize it and why and how. So uh, anyway, let's just go ahead and get into it. So in this case, you're looking at the debt, and you always want to start. This is just like any other debt elimination plan. You want to start with the debt snowball kind of thing. You start down on the low one, work your way up to the larger ones. And obviously, the reason why you do this is because now this payment, if you eliminate this $1,000 a month, you stop using that card, of course, and that $50 a month now gets applied over here in a way. It's a little different in this case because you would take this $50,000 a month and you reallocate it somewhere else. Okay, so what I want to show as an example is this right here. So this is a life insurance policy. Don't pay any attention to structure or anything else. Now, mind you, in this case, it may or may not be. Well, it's not even. Let's forget about the fact that it says the age is 15 years old at year one. The idea is it's just a cash value, and it'll be slightly different, for somebody older. But theoretically, for your average person, this is probably 30 or a 40-year-old that has all of this debt. So, and even then, some people take these out on their kids. That's what this one was someone that was taking one out on their kid. And, this can be their college fund or help pay for college. Now, college is so expensive nowadays. It can help with all of that. It could maybe be something that they could use to help them buy a car in the future. The point being with all of this is the idea of the cash accumulation and how you can use it as savings, and how you can also gain the dividends where you're getting the tax advantages of being tax free if it's done right. And any agent who's going to help you do this, who's going to help you do the debt elimination, who's going to do infinite banking type of situation, whatever you're calling it, be the bank, whatever. There's all kinds of different labels out there, but infinite banking was the first one out, in theory. So the idea is that you're looking at this, and so say in year one, you're saving money. This is at $5,000. Many people put away more, they put away less, but this is just for demonstration purposes. And in this case, we're just kind of looking at how things start and where they get. But just to give an idea, so they paid a total over the year of $5,050. It's going to be done monthly or in a single payment. You're going to come out a little better in a single payment because there are charges if you're doing it monthly with the insurance companies. But if it's structured right, nonetheless, you still are getting a good amount of the cash available, even with the cost of insurance. In the first 2 years, with many of these policies, yes, you will see less cash value for the simple fact that they front load a lot of the cost of the insurance. But ongoing, there will be a crossover, what's called the crossover point, and that's at which point you're getting more dividend than you are basically, and maybe that's a bad way of wording it, but you end up with more money than what you put in for the year. So you put in $5,000, and let's see, where's the crossover point on this one? That's about $6,000 differential right there. So you can see you put in 5,050. You see about a $6,000 differential, which means you got your 5 back plus another $1,000. So I've talked about this before. It's only going to go up each and every year. So here you see another 6 and a little more. Let's go down here. We'll go down to year 15. There's a $10,000 differential, $10,100 differential. You're more than doubling your money just for paying your premium. So anyway, that's not even the point of this video. It's just an example. So year one, we have a total of $3,949. And let's go back to our whiteboard. There we go. So say we knocked this, and just for the sake of being easy, let's just say it was a clean $4,000. We knocked out those first 2 debts. That'd be $210 a month. Now, what happens is if you've actually taken a loan against that policy from the insurance company, something you don't have to do anything more than either fill out a form or go in and click a couple of buttons on a login or a portal you have. They don't have to approve you. They don't have to check your credit. They don't have to do any of that. They don't have to check your income and all of that stuff. This is basically something you just request it, you get it, no big deal. Okay? You get this loan and you pay those 2 off. That $210 a month now, you're going to pay that payment that you would pay to those credit cards right here throughout the year, and until it's paid off, back towards your insurance policy, because it will reduce the cash value based on that loan, but you will get the benefit of the full amount of the cash value when it comes to the dividend every year. So they're not going to ding you in most cases, and mind you, there are some companies that will, but that also doesn't necessarily mean that you're going to end up with a lot less money, because they make up for it in other ways. So you end up, in a lot of cases, coming out really close to the same anyway. But in this case, for the sake of this, you're getting the full amount of the cash value. So that full $4,000 in cash value will receive dividends for the year, no matter what. Okay? So you'll be paying that off in the meantime, the $210. So year 2 comes around. Let's go back. Year 2 comes around, and there's a difference of not quite $5,000, but almost. So let's call it $4,700. 700, maybe a little less. Let's call it 45. Let's be easy. 45. So now you have 4,500 out of this 5 that you've actually paid in. And that 4,500 almost pays this off. Again, let's just be easy and call it 5 because it was like close to 47. Let's call it 5. That gets paid off. Now you're paying the 210 and the 250. You're paying $460 back into the policy or towards the loan repayment, which restores your cash value that it had subtracted for the loan. Okay, so you're going to have this amount of money, this $510 a month going into your policy. So now it's $6,000 a year that's going back towards your policy, right? I mean, unless my math is bad, at $500 a month, $6,000, and actually it's 6,100 and whatever. Anyway, $20. Anyway, but so now this is going in. That's the following year, right? So the first year you had $210 a month, and that was, let's just call that $2,500. The following year, you have that $2,500 that's been put back towards the cash value. You have actually, and in year 2, I did that wrong because realistically, that extra $2,000, the $2,400, I'm sorry, that would have been paid back towards the policy from the first 2 right here, that would have been available. So now you would have had actually more money. You would have had $2,400 in addition to the 5 that was available, which I rounded up. There again, don't yell at me. But the $5,000, so you would have had $7,400. So $7,400 would not only made a dent or paid off this third credit card, but it would have put a little bit towards the car. So now, whenever you're paying all of that in year 3, you've paid in another $5,000. Okay? Now, mind you, this is not a overnight thing, but it pays it off in half the time or less, depending on the amount of money you're putting towards it. And if you are disciplined and you do this, all it is a savings and an arbitrage of money on top of, if you look at the policy, let's just go year 11, okay? Year 11, you can see what is that about that's about $8,000 you put in 5. You made $3,000 just for paying your premium, and you got your $5,000 back, okay? Year 12, let's just go to year 20 here. Once you've been in, you're thinking, wow, 20 years down the road. Well, you're looking at a lot of it. I left off all the death benefit and all the, the increases in death benefit. I mean, that is a plus. I mean, that is a definite plus because you're leaving that to your family. Whether it's this is a kid policy like this one, or you happen to be on a kid, and they'll eventually leave it to their loved ones. Which this thing will be beautiful. I didn't even get into, because this thing, they're going to be 39. It's kind of cut off a little bit at the bottom here, but they're going to be 39 on this, and it shows that it increases by almost $20,000 when they pay 5. So and you may not be able to see it. It's a little bit cut off, and I'm having a hard time opening up the screen a little bit because it's not giving me the right type of arrow to expand it. But nonetheless, just to, you know what, scoot this down a little bit so you can see that. Okay, 24 to 42, what is that? Roughly 18, let's just call it 18,000, give or take a little bit. But for $5,000, I mean, come on. Now, think about whenever they're 60, 70 years old, what that's going to be in cash value just in general, and what it's going to go up every year. I'm only showing you what it goes up every year. I mean, which is amazing, which can be retirement money in itself, a return on your money there. But, and mind you, I'm not talking about just 20 grand. I'm just talking about in general that can supplement your Social Security, your IRA, whatever else it is, or for people who love whole life because of the safety of it, and then they compare it to what an after tax um, or what the tax equivalent is, meaning that if you put it into some sort of investment or whatever, and then you have to count fees, discount, you have to subtract the fees, then you have to subtract any commissions, which is usually 1%. But and sometimes it's 1.25 because the 0.25 or zero point 0.5 or whatever it is goes to a it goes to like a basically the broker dealer. But nonetheless, by the time you're said and done with, the rate of return is very comparable, and you also have the ups and downs you have to worry about, potential crashes and junk like that you have to recover from with a investment account. And I'm not against investments by any means. I'm just saying for the people who actually are risk averse and they're like, hey, I'm still getting the gain, a good gain. Why would I go and put my money in jeopardy? There's people like that. I'm pretty much, for the most part, like that. I do some other investments. Don't get me wrong. I do crypto stuff and stuff like that. And right now, that's um, for me, it's not so great. I know some people are still doing very well, regardless of everything that's happening because they're into binary options. That's nonetheless. That's here nor there. Anyway, my point being is that this is going to continue to grow. And whenever they're older, and mind you, they're young, they can keep getting it up. They can get other ones. They can get some on their kids. They can get multiple ones on themselves. I've probably got 4 on myself. I've got, just as many on my wife. I've got some on my kids. I'm adding one on each of us, between now and the end of the year. And it's strictly for the cash value. It's the cash value growth. Um, so anyway, so whenever you take those things, and I'm getting way off, but whenever you take those and you're rolling over the repayments and what's available to you for the year, the following year, so it was roughly 6,000 and change that was going to be available in year 3 based on the repayments. And then you're looking at with the difference between here, it's roughly another $5,000 for year 3. So maybe a little, well, what, 8? It's about 46. Again, we're going to round up just to be easy. So you've got about $11,000. So now you come over here. I'm sorry, I'm trying to get this. So now you come over here and you put the $6,000 towards the car. Okay? This can be done a number of ways. Most of the time, the car loan, you can get really like creative. Some lenders will recast the loan, meaning if you put a chunk of money down, so let's just forget the amount that you put down for right now, but just say you put down $10,000 and you want them to recast the loan, almost like refinance it. You could, but there would be costs with that. But it would lower your payment significantly. Now, the upside to that, potentially, you'd have to run the numbers, but the upside to that potentially is that this payment may go from $600 to $400. Let's just say $400. This would be easy. Now you have an extra $2,400 a year that you're paying back towards the policy or any loans outstanding. So that will go towards the arbitrage. So now that 6,000 and change or whatever it was will become another $2,400, and now you have $8,400, as say $8,500, because I think there was a little bit extra on the other thing. Mind you, I'm just kind of going with this, and I've had a lot of coffee today, so I apologize. And that's why I'm having to round up and not be so technical with the numbers. Normally, I can do these things in my head, but at the moment, I'm a little bit amped up on the coffee. But so anyway, you would have that amount. So let's just we're just saying $8,000, $8,500. So now that $8,500 in year 4 plus the difference here, right? So about 5. So that's 13,000 and change. And you've already paid in what 7 on the car plus a 13. So you're $20,000 into this paid off. You have $10,000 left. The following year, it's going to get knocked out, and then you're going to start on the house. And what's going to happen is that following year, whenever you knock out this right here, this 600 starts getting back into the whole thing. So now that $8,000 you were putting away, or 8,500, now it's 6 times 12, right? So you have 600 and what, 720? So $7,200 that you're putting along with the $8,500. So every year you're putting $15,000 a year. Now imagine you add that to the other stuff and you start paying down on your mortgage. And I'm just guessing at this rate, it'd probably be about, let's just say 12 to 15 years. And if you have a 30-year amortized mortgage and you're done in 15, and now you're putting all of these payments added up down here below every single year towards your policy. And when those loans are paid off, so what is this? 19, so let's call this 2 and 350. So $2,350 times 12, whatever that is. My brain, like I said, is not working. $2,350 times 12 is $28,200. Now you're saving that much a year. You've created this arbitrage of money, and that doesn't include whatever you have in cash value based on the payments every year, because you're still paying your premiums. That hasn't changed. You're not spending any more money than you were spending before. You're simply saving the same money, the same $5,000 a year. The policy is growing. You have more dividends, right, as you go. You've been paying yourself back, right? And mind you, you're not spending any more money than you were spending before. So you never made another dime at your job. This is assuming you made no other money. Steady employment, same payments, same everything. You didn't go out and buy anything new. And even if you did, there's ways to reallocate money and redo this, right? There's actual software that I use to do all of this for people, to show them a debt elimination picture when they do that. I don't have as many clients as I used to that do it. I have a lot of clients that do real estate and do other things, own businesses and whatnot, and they use the money to finance business type of ventures, whether it's a piece of real estate, or it's to finance a piece of equipment for the business, or maybe they just finance their business in general and use it as a write-off. It gets a little more complicated than that, but once you know what to do, it's not complicated anymore. It's just informing yourself. But nonetheless, for your average person who's like, I don't have a business, I have a W-2 job, I have a steady income, whatever, I have debts, I've got kids, I spend a lot of money. This right here makes all the difference. I'm not changing your lifestyle. You're not having to make another dollar higher than what you're making now, which you probably will anyway. And everything's getting paid off, and you end up with you saving a boatload of money. And you're just like, what happens whenever the loan's paid off? Well, when the loan's paid off and you don't have anywhere to put the money, you start another policy. Or maybe you start a policy earlier than that. You're putting away $28,000 a year. You're doing it 5. At any point in there, you can start another policy, and for a bigger dollar amount per year. And all of these numbers, and mind you, it doesn't have to be this company, and it's going to be different with different companies. And this is just an example. This is just what I dug up at the moment on the fly. Uh, but I make up a custom design, and depending on the company, which one fits best for the situation, and we do it. So you know, we go through that, we set all this stuff up, and we make sure that it works. It works for your purposes, right? So if you want debt elimination, this is what we're going to do. And then after debt elimination is done, and somewhere along the line, maybe you started more policies, and that started helping bring you more dividends and maybe faster debt pay down, which it will. Um, it may shave a few years off if you started one every couple of years. Some people are like, well, no, no, why would you do that? Well, you have an excess of money, and you can do bigger policies that are going to grow at a larger rate in a way because it's a larger sum, right? So the dividends, so say net dividend after expenses is 4%, and you're going to make 4% no matter what, and the amount's only going to go up. It's never going to go down. There's never any losses per se. It would make sense. And so now you have multiple policies, and you do all of these things, and you end up with more money all the way around. And so, I mean, in my eyes, why wouldn't you do this? Like, it's safe money. Like, who doesn't like safe money? I love safe money. I have 10, 12 of these things myself. So I practice what I preach. I've been doing it for 14 years personally, even before I was actually setting these things up for people. I benefited from it first and went through the process and learned about it and got in detail and know how to structure policies no matter what the situation. I can structure a policy almost any way depending on the company. There's a lot of different ways to do it, and there's a lot of different ways based on need. Anyway, I hope this helped. I hope that it made a little more sense. If it didn't, or if somebody would like to see something different as far as laying it out, maybe I'm not that great with spreadsheets, but maybe a spreadsheet or something different, I'd be glad to do it. It'll take me a little bit of time. You'll have to bear with me, but put in the comments. There's links down below if you want to schedule a consultation regarding the debt elimination strategy. We'll go through. You'll have to give me some pieces of information. Give me like all of your debt, the interest rates, the monthly payment that you're paying, what the minimum payment is, for example, on a credit card, but what are you paying, or maybe what's your car payment, but how much you're actually paying. So maybe it's $600 a month, but you're paying $800 trying to pay it off faster. Whatever the case may be, you would give me all of that information. Of course, I'd get your basic information, your regular information, date of birth, and a few other things, just to be able to do an illustration. And then, of course, how much you're saving a year. Maybe you already have a savings. Maybe you have 10 or whatever. Like I say, maybe there's $10,000 you put away, and you're like, hey, kid, if I put $10,000 into this policy, will that speed things up? Of course it will. That'll make a big difference. So we can start with that plus whatever you're saving monthly, and you will definitely move it along even faster. So for those of you who want to check it out, there's links down below. If you like this video, please click the like button. I always try to provide any kind of value that I can. And if you found it, if you found this information, worthwhile, please subscribe. I try to put out more content and show you guys some more of these types of things, strategies. Of course, my specialty for the most part is whole life, but I also do long-term care and different things, and I can go into the many reasons as to why you would have long-term care or an annuity based on age and different things. They're things that I do only because I've seen a need, only because I have elderly parents and been through some things with them and seen it with others as well. And until you experience it, In some cases, it won't hit you, but whenever you actually experience it, it opens your eyes. So for those of you who can do it early on while you're young and set these things up, that is the best time to do it. Anyway, I am getting very long-winded with this. I'm going to go ahead and cut it off and say we'll definitely catch you on the next one. I hope you found this helpful and have a good one.